Nigel, it's always a pleasure to have you here. Thank you for joining us today. Today, we'd like to talk about operational resilience, and specifically operational resilience in financial services. So this is a topic that is becoming very hot these days. For example, here in Australia, one of the key regulatory bodies, APRA, has just finalized their consultation stage on a new standard that goes under the name of CPS 230 and is indeed about operational resilience. So let me start by asking you, what is operational resilience?
Hi Marcello, and thanks for asking me to come along again. And yes, you're absolutely right. So from the regulator's perspective, it's really operational resilience is about that ability to work through a disruption. Now, sort of in a broader context, when we think about operational resilience, if we start with operational risk, it's really the potential for unwanted negative events. And operational resilience is really the ability to both prevent, withstand and recover from those events. So that's all wrapped together in terms of what the regulators want is financial services just to keep working when bad stuff happens.
I see. So it's about preventing, withstanding, and then recovering.
That's
recovering
correct.
from negative events.
That's right.
So we've seen indeed operational resilience being dealt with in other verticals in the past. For example, after COVID struck, immediately after it struck, we saw a lot of organizations in the supply chain management space working proactively towards becoming more resilient in their operations. I'm thinking, for example, of how the whole chip manufacturing industry has been disrupted. And I can see why that was the case because of a global pandemic. But now let's come back to financial services in particular. Why it is hot these days in financial services?
So I think the pandemic's clearly had an influence on this, and you couldn't have had a much bigger, unexpected event with negative consequences than a pandemic. And what really seems to have triggered a lot of the discussion in financial services is that the BAL committee, which is a committee of the Bank for International Settlements, published a paper in March 2021 around its principles for operational resilience. And there's an immediate connection there to, well, this must be just because of the pandemic. The roots of it actually go much further back to the financial crisis of 2008. And whilst we're trying to deal, a clear disruption is a pandemic or an environmental event like a flood or sort of a fire or some other type of disruption. One of the things the regulators in financial services have been concerned with since the financial crisis of 2008 is that they've recognized the impact of digital transformation. And as more of their services have become digitized, customers' expectations have changed. They expect these services to be always available. 25 years ago, you might go to the ATM once or twice a week, take out your cash for the week, and that was it. You didn't need to go and deal with the bank again. But nowadays, you're checking your phone, see how much money you've got going on. You're paying for your coffee, you're paying for your lunch by tapping your phone. So that dependency on financial services in real time has greatly changed over the last 25 years. At the same time as that transition, the number of third and fourth parties that are now part of that ecosystem, specialist technology providers, fintech providers, there is a much greater dependency on multiple players, all of whom have different sort of levels of operational risk capability. But from a regulator's perspective, you can't see it. And the underlying influence is you go back to the institution that you're regulating, but they may be held to ransom in many ways by a much smaller player who isn't aware of the role that they play in that chain, which is why one of the sort of the key key principles or key changes in how the operational resilience is being thought of, it's not just a function that we're looking at now. It's a whole operation, which is an end-to-end service and all the resources and all the suppliers that contribute to it. So the BAL committee came out with this paper, and since that time, regulators around the world in the UK, in the EU, the US, Hong Kong Monetary Authority of Singapore, and as you referred to in the introduction, APRA, have started to then sort of put their own standards together about how resilience needs to work in their jurisdiction.
I understand. So the landscape has become much more complex. On the one hand, we've got a lot of players in these ecosystems, not anymore just the traditional large banks or insurance institutions, but also a lot of smaller players, a lot of fintechs, especially pushing through new emerging technology. On the other hand, we have customer demands that have dramatically increased. I want everything, and I want everything now at my fingertips. I want to check it from my phone or from my watch, right? So definitely there is a stronger need for becoming resilient in operations in financial services these days. But how do organizations approach it? How would a large bank or even a smaller player, like a smaller boutique insurer, would approach this topic?
So I think, if I draw on my own experience, there are three types of events that when I ran payments, three types of events that sort of I thought about in quite different ways. There's one which I would classify just as a retail payment event, and this is where something to do with the card-based system. So your Visa card, your MasterCard, your debit card, the tap and go on your Apple Pay, etc. When that failed, so there's some issue there. Clearly that impacts a very large number of customers. And this is when the contact center, the phones ring hot. Ultimately, there may not be a lot of money at risk here. So it's a different type of risk. But in terms of reputational damage and customer impact, it's extraordinary. The next type of event was where your internet banking, there's some issue with your internet banking. Now, for most of us, that means we might not be able to pay a bill, we might not be able to check our balance, etc. But for large employers, the worst thing for me in my payments operational role was employers not being able to make payroll, because of the contagion impact of the union relationship with the employer, people not being able to if they don't receive their salary or their wage on time, they can't pay their rent, they can't pay their mortgage. Once again, huge sort of impact on a number of people, but from different aspects of the system. The third one is, most people wouldn't know it existed, but it's when the banks themselves can't settle. And this is where the Basel Committee was really worried, because that contagion effect that they saw coming out of the global financial crisis was where large banks suddenly no longer trusted their counterparties and they couldn't move the huge swathes of money. Ordinary people in the street, I've got no idea that that's going on, but that's a very different type of risk. So this operational resilience covers those three types of events, plus the fact that you've then got natural disasters, you've got pandemics, you've got floods, you've got strikes, you've got bushfires. All those are the things that interrupt the flow. And so the traditional approach is there are four things you do if you want to build operational resilience. First thing is you've got to identify your failure points. The second thing, once you know what your failure points are, you then have to try to design them out. So the best process is one that can't fail. They don't exist, but you try. Acknowledging that all processes will fail at some stage, when a process does fail, your task is to try and contain and mitigate the damage that process failure can create. So we all know about insurance. We buy insurance systems, or it's very common practice now for most technology companies to have DR strategies where they've got sort of, there's no single point of failure. They use two sort of telcos to provide telephony services in case one goes down. They've got two cables coming out, multiple data centers, etc. So that's a form of containment strategy. And then the third one is the fourth step is recovery. So when the event has actually happened, you've contained it to the extent possible, you need to get back up and running to your business as usual type activities. And there's a whole strategy around that. There's a whole activities that happen behind the scenes to bring the processes up. There's a whole stream of activities under crisis management about communicating with customers, communicating with regulators, with government, etc. So these are four steps. And there are toolkits that have been used by financial services around the world that try to deal with these. The issue is right at the very start. So that idea of identifying your failure points, the traditional toolkit is you look at your process maps. Unfortunately, the process maps have been driven by getting a bunch of experts in the room, looking at data from provided by organizations such as Oryx, which captures and disseminates worldwide risk events. no two banks are the same. So just because a particular payment stream or a deposit system or a customer crisis has happened in Bank A has absolutely no bearing on Bank B. You hear things like this is a 1 in 100-year risk. It is a complete nonsense. No, banking systems didn't exist 100 years ago the way they do today. So it doesn't fill me with any confidence. And the question I used to ask was, well, can you tell me when the last event was? Because if it was 99 years ago, I think I'll resign now before it happens on my watch type of event. So the types of data we use, they're almost like a comforter, but they're not actually getting to the nub of the issue. And that is that the processes that are involved in these large financial services, as early adopters of technology, the processes have evolved over many, many decades. And it's not uncommon for these organizations to have technology in place that's 20, 30, 40 years old, cohabiting with technology that's 1 year old, 2 years old. And at the same time, they've been through multiple restructures. And every time they restructure, they carve up the process and allocate bits of them elsewhere. So you've got mass fragmentation of processes. You've got legacy technology. You also have this issue of the data's not joined up, so you can't actually see what's sort of going on, and you can't actually sort of visualize the outliers. There's so much variation, and as we know, operational risk doesn't eventuate on the happy path of a process, it eventuates in the weeds, the outliers.
The outliers.
And the happy path, which has been built by a couple of SMEs in a room, being asked some questions by the risk folk, doesn't really tell you anything about that. And that's the issue which has made it such a hot topic for financial services, in my opinion.
So you mentioned something very important when you talked about why it's such a hot topic. Is it how we go about it, which is we need to use a process lens to be able to understand everything that is going on, to be able to map out our operations. And specifically, as far as operational resilience is concerned, use this process lens as a starting point to identify the possible failure points, right?
That's absolutely right. So
that's the starting point.
A typical tool we would use to try and understand our failure points is failure modes and effects analysis. Very common in the Six Sigma, Lean Six Sigma type toolkit. Been around for a long time. When I sort of went to my sort of most recent organization, we were moving lots of processes around. It was one of my mandatories. Before you move a process, you have to do an FMEA. And it's great. Really does help you understand the inherent risk and which risks you're prepared to accept, which risks you need to sort of to work on. But the issue, once again, is you need to have the understanding of the as-is process. And using those traditional toolkits of the subject matter experts
so the
doesn't get you there.
Interviews, workshops, observing how people work in reality.
And it's very rarely done on a dedicated basis. People are doing this off the side of their desk. They're doing their day job. They're giving you an hour of their time so that they can try and help contribute to the documentation of the process. But their phone's going off. They got sort of emails coming on. They've got other issues. You never actually get to what all of the variation is inherent within the process, and at the same time you don't get the data. Now if we think about a critical aspect of financial management in a financial services businesses is calculating operational risk capital.
Correct.
It's very hard to do if you don't really understand the true nature of where risk resides within your processes.
So now the next question, which comes very natural, is can process mining help with operational resilience? So if a few years back, process mining was still an emerging technology, now it is a well-established tech capability. Gartner came up with the first Magic Quadrant on process mining a couple of months ago. So now there is an explicit recognition, acknowledgement of such a capability within organizations, especially in financial services, and that recognition has gone up to the board level. We see more and more our customers, organizations discussing process mining as a key strategic capability that they are to build or that they are building. And we know the many use cases for process mining, helping us with customer experience, helping us with digital transformation, operational excellence. but more specifically for operational resilience, where can process mining help and how?
So I mean, that's a good question, Marcello, because as you know, the reason we sort of came together in the first place was because of this very issue. It's the transparency and the visibility. And I think I mentioned to you when we first met that, you know, when it comes to the half year end, and as a business leader, you have to attest to the understanding of your business to the extent that if there's anything that has happened that could materially impact the financial statements, you need to disclose that. Now, when you're in charge of a function like payments, it doesn't take many transactions to go wrong to impact the financial statements of an organization. And my question all those many years ago was, how do I know? I might have my key risk indicators, I might have my key control reports, but how do I know? I don't have anything that tells me that every single transaction has been performed within specification. And this, for me, is where process mining really came to the fore. The ability to take data representative of the full population, not a sample of all the transactions that have been performed, derive the process, not only show you the happy path, but more importantly, from a risk perspective, all those outliers, and apply data to it so I can see my cycle time, so I can see my costs, so I can see which transactions are the rogue transactions and understand why they are the rogue transactions, which happen in which center. So I know if I lose a particular center, then am I going to be able to perform all transactions in my backup center, or are there a certain tranche of transactions where my specialist expertise resides in one center only,
yes.
And if I lose that,
that's it.
They're gone. I'm not going to be able to process them. And obviously COVID was a great example of that, where depending on the jurisdiction you're in, some centers couldn't do the work from home as quickly and as effectively as possible. And organizations then developed huge backlogs as we were processing. But you also touched on another really interesting point about with the Magic Quadrant, raising the sort of the profile of process mining to a board level. One of the key things that's coming out from obviously the regulatory standards around operational resilience is making boards accountable for it. You can only do that if you can connect the data. You know, there are millions and millions of transactions a day, each of which has the potential to create an operational event. Board members don't have the time or the ability to dig into every single one of those. They need to know that the information that is being filtered up has come from a reliable source that recognizes the full population of risk potential. And that's what process mining for me does, is as well as it gives the operators, the business analysts, transparency to go and look for their improvements, look for how they build their resilience, it also is a feeder up the line to the board so that they can truly understand the operational risk that they're carrying. They can calculate their operational risk capital with a lot more accuracy than they would have been able to do prior to these types of tools being introduced.
So Nigel, you talked about process mining as an enabler to achieve transparency and traceability,
Yep.
and that indeed goes under the fundamental process mining capability of automated discovery,
Yep.
as Gartner has also called it in its Magic Quadrant. Is there any other capability of process mining that could become handy for operational resilience?
There are quite a few of the different techniques that I would use in different ways. I mean, the first one, obviously, there's a big requirement on building your business continuity planning techniques. When you're building and designing business continuity planning, the ability to simulate and test different options and permutations. For example, the example we just discussed was I operate my processes over 3 distributed centers to try to make sure that I've got some resilience there in case I lose one of the centers. Maybe there's a strike, maybe there's some natural disaster event. But have I got true replicability in those 3 centers? Or is it, well, you have for most types of transactions, but there are certain transactions which can only be fulfilled or performed in one center. What can I do about that? Trying to surface that without this type of toolkit is really difficult. And then once you have the toolkit, then trying to simulate, well, what happens if I do lose that center? Where will those transactions go? And how am I going to manage them? That is the simulation capability is a great opportunity to really understand your resiliency and to demonstrate to regulators that you have a business continuity plan that is not only a piece of paper, but is actionable, and that you don't just do once a year type testing to say, I've got a BCP that works, that you're almost testing it continually. From a performance perspective, one of the really interesting factors here is that something I noticed, we had sort of a major event a few years ago where what I couldn't understand was we lost half the capacity. We had an issue where we couldn't process. The time when you're in payments is you have cutoffs throughout the day. We went through getting close to cutoff and we lost a number of hours of processing time. So ordinarily, in nearly every type of operation I could think of, once you come back online, your throughput rate should just achieve its prior throughput rate. So in theory, I shouldn't have been able to process, or my team shouldn't have been able to process all those payments. But somehow they did. So how can they double productivity? What has happened? Inherently, you sense that, well, we did it because we needed to get the customers their money, but at the same time, surely there's some risk that we've taken on there. We must have missed some steps or skipped some steps. So in terms of not wasting a crisis, there's a great opportunity there. And once again, by comparing variance, I can compare my performance prior to the crisis and during the crisis, look at the two. What have my team done to double their productivity during that crisis event?
So I can learn from it and try and replicate at scale.
That's right. Now, is it just my team are working twice as hard, which clearly is not sustainable? Are they taking shortcuts, which may introduce risk? Or maybe they're just redundant steps in the process that aren't required and have no extra risk.
Can be removed.
So I can use variant analysis to compare the two. And then clearly, the other tools such as predictive and prescriptive monitoring. I don't want a risk event to materialize. I need to know my server capacity is filling up, so I need to allocate more server resources. I need to know my processor capacity is about to take a hit because a large group of people are going off on a training event or something like that. Mm-hmm. I need that predictive ability to be able to tell me before an event happens, so I can take action. And that is the holy grail of resilience management, is how to prevent things doing. And you need the insight from those tools.
And that's when we move from a tactical analysis based on historical data to operational intelligence.
That's right.
Based on data that relates to cases or processes as they unfold, payments, loan applications, claims, and so on. Yep. So Nigel, you touched upon a number of key capabilities of process mining. You talked about automated discovery to achieve transparency and traceability, performance mining to identify friction points and other parts of the process where we lose performance, where performance deteriorates. You talked about variance analysis to try and learn from positive deviances so that we can understand if and where we can replicate under what conditions. And then eventually you talked about predictive and prescriptive monitoring to lift the game from tactical to operational intelligence.
I've missed one.
Sorry?
I've missed one. The other one is either conformance or compliance analysis.
Of course, yes.
And clearly compliance analysis is just making sure that the way, it comes back to the original motivating case for me, why I got involved in this topic, was to make sure that your processes are following the prescribed standard of how they should be operated. And being able to use conformance checking or compliance analysis to test that is a critical part of proving that you have a resiliency plan in place. Now, I've talked a lot about payments in this type of scenario, and things like whether it's opening accounts, whether it's paying an insurance premium, whether it's generating a funds management report, whatever the case may be. These are all services which are core to the respective provider. One of the things that the focus on resilience is getting to as well, though, is this notion of third and fourth party providers. So the procurement function comes into focus here because it needs to attest that each of the respective third and fourth parties that are actually contributing to a critical operation meet the required standards. So compliance testing of the procurement process, that those parties have been identified and that the attestations and the evidence to support the claim that they are authorized to third parties with the appropriate sort of resiliency capability inherent within their operations is another great way of how this type of tool set can be applied. It's not just for your core services and your core operations, it's also for your support operations as well.
Absolutely. So conformance checking or compliance analysis is particularly relevant when we want to check the level of compliance of our processes to regulatory standards like CPS.
Yeah,
230, right, that we were mentioning at the beginning. So we've got a broad range of capabilities within process mining. For a financial services institution to get started, how would they go about it, right? So what would we start using first?
Well, I mean, I think the important thing to say is all of the financial services in mature economies, in large economies, mature economies with mature financial services, they're already doing the operational resilience. They have BCP, they have disaster recovery, they do sort of go and calculate their risk capital. So they're doing these things. It's about enhancing it, making it more accurate, more complete, faster to deliver, easier to work with, and to bring in some of these newer tools around how you can actually sort of prevent. So it's an enhancement to what they already have, which is good because it makes it much easier to start as opposed to coming up with something completely new. The first start point, obviously, is process discovery, because it has so many other applications as well as just resilience. But you take a process that is, it may be that it's one of your critical operations, but you take just a subset of that process just so you start to understand the tool set and you start to understand how it can be applied.
So start small, try it in a sort of...
Test it, understand its capability. Right. Am I going to be able to calculate my operational risk capital out of this? Am I going to be able to do simulation to help test my BCP? Because the regulators have made, they don't prescribe what tools you use, they just prescribe what the outcomes. That's another change. It's a focus on outcomes. What are the outcomes I expect? Now,
how to get there is your problem, basically.
That's right. And at the end of the day, what the regulator is looking for is to make sure that we acknowledge there will be disruptive events, but we want to know what is your risk appetite for those disruptive events and your ability to operate through them. And so that means you then have to start to get the intelligence and the data to be able to inform your risk appetite calculations and the risk appetite that gets signed off by the board, at the same time to ensure that the capability of your processes to operate at that level is indeed correct. Now, once again, you can't do that just by asking a bunch of SMEs. How likely are we to fail? But when you start to have 12, 18, 2 years, 3 years of detailed transactional data, and all those little hiccups and all those little events, they can start to give you much greater insight into your likelihood of failing and where those failure points are. And as we said right sort of at the beginning of this, the first part of this is identifying the failure points. So you take a tool set like process mining in a relatively small scale, so you learn how to drive, you learn how to use it, but you have to discover the process so that you can then provide input and insight into your failure modes and effects analysis or your failure point identification.
Absolutely. Nigel, I'd like to thank you for this quite insightful conversation on operational resilience, and I hope our audience has now got a fresh new look into how we can tackle operational resilience using process mining as a rich set of capabilities for financial services. Thank you.
Thank you. Cheers, Marcello.